do not trade as if we're in a bear market. We're not. Anna, what does that mean?
Well, we spoke about earlier this year how there was a fear of the bear market, another repeat of 2022. But to us, we don't see those same signs. The Fed has slowed down considerably. Credit markets stay healthy. The consumer continues to spend, and wages are continue staying strong. This is not the signs of a typical bear market. At the same time, we're not expecting this massive bull rally either because we don't quite see the catalyst there. So rather than trading fearfully and too defensively, we're still on the offense here looking for opportunities in the equity market.
So, Anna, just to be clear, this is another way of saying October was the low for you. That was the low.
We won't say it's the ultimate low. We do think that equities can drop lower, but for us, it would take a lot to see those October lows again. It would have to be a quite extreme case. And part of that right now, we don't see it lining up that way. Now, we always love to talk about tail risks, but our base case scenario is that in the near term, we see more upside for equities.
And I want to go away from your quantitative analysis and go to what you think is fundamentally going to happen in corporations. I know your love for Team Mercedes and you, Louis and George, just want to go faster. Are corporations going to be able to go faster given high interest rates? Are they going to adapt and adjust constructively?
I think they're still going through those growing pains right now, and they're really wondering if the consumer starts to weaken, can they make those changes effectively and in time? So for us right now, what they're showing is that they're passing along price. They continue to, but almost across every industry, except for a very select few, you are seeing that volumes are down, and that price elasticity is really biting into margins consecutively quarter over quarter.
This is brilliant. I want to talk to you about the elasticity of profit-making, free cash flow stocks. Really, I know you like mid-cap growth a lot, but there just seems to be a massive skew in the market. I'm using it as a general phrase, a massive skew between those making money, the haves, and many, many others, the have-nots. Is that how you see it?
Well, there is certain extremes. You are seeing those industries, especially now that we are a couple years out of the pandemic, they're not so much that stay-at-home trade. We've also seen structural changes in people's preferences now coming out of the pandemic. Not as many people working full-time in the office. These structural changes, again, need time for corporates to really swallow and learn and grow from that. At the same time, even with slowing earnings and corporate growth, we are seeing positives for the equity markets because we continue to see that in the yields market that people continue to believe in growth. You're seeing real yields continue to go higher even as inflation expectations are repricing. So these are the kind of good and the bad things you're seeing that you mentioned.
So where does this shake out in terms of what the ramifications will be for equities going forward as we see rates perhaps go higher and stay there? Are you on the Greg Bowdle idea of things where you could see perhaps 3,400 in the S&P, or are you saying that we basically aren't going to retrace that much? We're basically seeing a new reality and people have adapted and adjusted.
Lisa, I think that 3,400 you mentioned, you need to see some sort of shock to the system. You need to see some very spiking in credit spreads or in yields. And you need to see a spike in inflation readings or a aggressive drop in the labor market. And right now, that's not our base case scenario, something we certainly are cautious of. And we're looking left and right and watching all the indicators for. We're not quite seeing it. So in the near term, we think actually things line up a little more positively for the equity market. But for that to continue, we really need to see that as inflation expectations continue to remain sticky, that still gives the Fed a little more room not to overdo it. And we see Fed communication continue. These are all the things we want to see persist. And that persistence and consistency is what's going to make us feel better and more encouraged about equity investing.
Let's build on that. Today at 10 a.m., we're going to hear from Fed Chair Jay Powell. I misspoke earlier. We are not going to be hearing at 9 a.m. that sneak peek. We were going to get it released at 10 a.m. And I'm wondering if there is anything that he could say that would make you really rethink your more positive tilt. Is there something in particular that you're looking to understand more directly that you don't have a full handle on yet?
I would say consensus-wise, you've heard a lot about the 6%. Suddenly the sentiment on Fed funds and where they could go with the terminal rate. If Chairman Powell comes out and says something overly aggressive, which we think is unlikely, but potentially something could be interpreted as confirming that 6%. I think that could be quite shocking to the equity markets. That's unlikely, but again, something that we consider if we're talking about tail risks. On the other hand, if Chairman Powell comes out quite dovish, that could also encourage the market to flip back towards retreating yields, or if we see again at the end of this week the labor market signs, or if we see next week's CPI print, all these together are showing a mixed message rather than a coherent and same direction message. I think these are the things that the market is going to have to reprice and churn a bit for.